The United States has witnessed an unprecedented 12 quarters of continuous and exorbitant price growth, leaving potential homebuyers concerned about the future. According to Redfin.com, the average homebuyer's housing payment has surged by over 90% since May of 2020. Just 3 years ago, the average monthly cost for a new buyer was around $1,300, but today it has soared to a record high of $2,566 per month. As the housing market becomes increasingly unaffordable week by week, it becomes clear that we might be facing a housing bubble. The critical question remains: how and when will this bubble burst? When can we expect prices and monthly payments to return to more substantial and sustainable levels? There is no need for complex graphs or exhaustive data analysis. The evidence points to a potential crisis. Join us as we explore Phase 3 of the 2023 housing crash and attempt to unravel what lies ahead for the housing market. So let's dive right in. According to data from Fortune, housing prices in October of 2022 saw a remarkable increase of 38.1% compared to their levels at the beginning of the pandemic in March of 2020. However, a shift occurred in November of 2022 as prices began to decline, dropping by 2.4% from the peak recorded in June of 2022, as per the Case-Shiller National Home Price Index. Multiple reliable sources are now predicting future and further declines in housing prices, with experts foreseeing a potential 10 to 15% drop by the second or third quarter of 2023. Additional indicators suggest the likelihood of a forthcoming correction in home prices. As reported by Reuters, U.S. home construction experienced a decline for the third consecutive month in November. The Commerce Department's report reveals that single-family houses starts dropped by 4.1% during the last fall season. These figures raise concerns about the stability of the housing market and hint at the potential for a further adjustment in home prices. The housing market downturn could be accelerated by economic uncertainty and an increase in unemployment, potentially resulting in the most substantial housing correction since the post-World War II era. Presently, this correction ranks as the second largest in the post-World War II economy, trailing only the housing market crash and mortgage crisis of 2008. To grasp the magnitude of the situation, it's worth noting that even if the housing prices were to experience a 20% drop through 2023, they will still not return to their pre-pandemic levels. The challenges faced by the housing market highlight the severity of the current situation and underscore the potential long-lasting impact on property values. When it comes to predicting the housing market, only one of the most crucial data points to consider is inventory. Inventory, or the number of homes available for sale, has a significant impact on housing prices, buyer demand, and overall market conditions. It provides valuable insights into the supply-demand dynamics and helps us to understand the current state of the real estate market. Looking at the current inventory situation, we will find it is still below pre-2020 levels. Data from Alto's research reveals that the number of homes for sale is surprisingly low, especially when compared to what was considered normal in the years prior to 2020. Currently, there are around 400,000 single-family homes for sale, which is an improvement compared to previous years, but still well below the 800,000 homes available in the pre-2020 era. This tight supply of homes has significant implications for the housing market, with fewer homes available for sale. The demand often exceeds the supply, leading to increased competition among buyers and driving prices upward. The low inventory levels contribute to the rising cost and affordability challenges faced by buyers. In the housing market, there is an ongoing battle between tight inventory and affordability issues, which significantly influence housing prices. On one hand, the limited supply of homes for sale pushes prices upward due to the high demand and low availability. This creates a competitive environment where buyers are willing to pay more to secure a property. On the other hand, affordability concerns exert downward pressure on prices. As prices continue to rise, it becomes increasingly challenging for buyers to afford homes, leading to a slowdown in demand and potential price corrections. The Federal Reserve's decision to raise rates in January of 2022 played a significant role in this battle. Prior to the rate hike, prices were experiencing a period of rapid growth, with the average monthly mortgage payment increasing by a staggering 90% since May of 2020. However, the rise in interest rates caused mortgage rates to spike, leading to a substantial increase in monthly payments. For instance, a typical 30-year mortgage went from 3% to 7% between January and October of that year, resulting in affordability challenges for buyers. As a result of rising interest rates and monthly payments, the housing market experienced a slowdown in price growth. Affordability became a critical issue, reminiscent of the challenges faced in the early 1980s, while the Federal Reserve's actions helped cool down the market and prevent a collapse. It also created obstacles for buyers, especially first-time homeowners. The stabilization of rates to the 6% to 7% range, along with tight inventory, further contributed to the affordability concerns and the battle between supply and affordability that we see today in the housing market. Enjoying this video? Give it a thumbs up and share it with your loved ones. Don't forget to subscribe and hit that notification bell to stay updated with our latest content. Now, let's jump right back in. As we look ahead to 2024, it's important to consider the forecast economic slowdown and growing evidence pointing towards an upcoming recession. The US economy has been showing signs of deceleration, and this is a sentiment echoed by economists and business leaders across the country. When we examine indicators such as Treasury spreads, which have accurately predicted the last 8 recessions, we find cause for concern. These spreads, which measure the difference in yield between long-term and short-term Treasury bonds, are currently flashing red. In fact, the probability of significant economic turmoil in the near term is estimated to be as high as 68%, the highest we've ever seen since the early 80s and even surpassing the levels observed before the 2007 financial crisis. In addition to Treasury spreads, other key indicators further substantiate the likelihood of an impending economic downturn. The Empire Manufacturing Index, which is a reliable survey measuring the health of the manufacturing sector, recently experienced an unexpected collapse, recording the single biggest month-over-month drop in history. New orders also fell near record lows, indicating that the upcoming recession may be far from mild. Moreover, first-hand accounts from business leaders across various industries are pointing to the end of a golden period and anticipation of challenging times ahead. While we haven't yet felt the full effects of this economic downturn, many economists are in agreement that 2024 will be an ugly year. When we consider these indicators, collectively, they paint a worrisome picture of the future. The high probability of significant economic turmoil in the near term suggests that we should prepare for the challenging times in the housing market as well. The housing crash of 2024 could be the beginning of a long-awaited cycle reversal, with a projected decline in housing prices of around 15 to 20%. While it may not reach the severity of the 2008 crash, we can expect a substantial correction that takes us back to 2021 levels. This decline will put the ball on the side of buyers and alleviate some of the intense competition. Factors influencing the crash. One of the key factors that will heavily influence the upcoming housing market crash is the potential actions of the Federal Reserve regarding interest rates for the rest of the year. While there is a market consensus that the Fed may pause with rate hikes, it's important to understand the implications of such a decision. Breaking the back of inflation is crucial, and early pause in rate hikes could undermine the progress made in taming inflation. If the Fed fails to tighten the screws all the way, there could be severe consequences. Investors play a significant role in the housing market. Their response during the initial tightening of rates in 2022 was crucial. Many investors paused their buying spree but did not actively sell their properties. This decision has contributed to the ongoing supply shortage in the market. However, as Phase 3 of the 2023 housing crash unfolds, we can expect the next phase to be marked by investor capitulation. During this phase, investors who have been holding on to their properties despite the market scare in 2022 will likely reach a breaking point. They will start actively selling their properties, adding to the supply in the market. This shift is essential because existing homeowners with low mortgage rates, who make up a significant portion of the market, are unlikely to sell even if the prices start to decline. Therefore, for inventory to move and for prices to experience further downward pressure, it will largely rely on investors relinquishing their properties. As the panic phase ensues, existing investors will face mounting pressure to reduce prices significantly to attract buyers. This will create a self-reinforcing cycle there where demand dwindles, offers dry up, and buyers wait for further price reductions. The market will continue spiraling downward until a bottom is reached. The decisions made by investors during this phase will greatly impact the housing market's trajectory and determine the extent and duration of the housing crash in 2023. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.